Hey, this is Dutch from Carnivore Trading. I want to talk to you today about scaling. We call it scaling, as other people call it pyramiding into winners. This is a technique that really works, especially in either short-term trading or swing trading like we do. Our trades are normally on for anywhere from 3 days to 7 days up to 2 months. We can be also called position traders from time to time. So one of the things you want to do is you want to check the market tone first. The market tone is critical. You want to make sure that you're not trying to scale into a long position in a market tone that's negative and selling off. It's going to be impossible to do. So you want to find a day when the market is moving up, that's coming in your way. Maybe it starts off fairly benign, but then it starts to gather some steam. That's the perfect day to start doing some scaling. So you've got a stock that's got some mojo. You bought it at $20 a share. You bought 1,000 shares. Then you go from 1,000. The next buy that you add might be at $20.30. That's going to be something that maybe you do 200 shares there. So 20% of your initial position. The next one might be at $20.60 or 75 cents. So you'll do another 200, 250 shares there. So then you get to 21 that day. Maybe it's 21 and a quarter. You're going to buy another 200 shares. That's scaling into a winner. You're buying it as it's moving in your direction, okay? The way to think about this from a mental standpoint is I'm going to reward the stocks that are winning for me, and I'm going to punish the stocks in my portfolio that are not moving my direction. Those are stocks I'm selling, and I'm using the capital from the losers to pay into adding to the winner, okay? So mathematically, we're going to go through this in a minute, but mathematically, you can actually pick 10 stocks and buy $10,000 of each one. You can be wrong on 7 of them where they go the wrong direction. Let's say 2 of them are not going the right direction, but they're not going the wrong direction either. So they're kind of flat for the day. But you've got one that is moving, and it's moving really righteously for you. It's moving your direction. That's the stock that's going to be getting the new capital from the losers that you're selling. That's the stock that you scale into. Now, let's say that stock goes from 20 to 21 to 22 to 23, and at the end of the day, it's at 23 and change, and you've got a nice large position in that. All right, the next day or the next 2 days later, the same thing's happening. This stock is moving your direction. We've had several that do this. One of the stocks that we did recently was Upstart, UPST. We actually bought the stock below $20 a share in the 19 area, and it is now a $64, $65 stock. Now imagine trading into that position and scaling into that position and adding to that position all the way up to 65. Now we don't normally carry it that far, but that was only 2 months ago. This is the end of July in 2023. 2 months ago, that stock was a $19 stock and it's now a $65 stock. So we caught that trade properly. We scaled into it. We took profits along the way. It would dip back. We would buy it again. It would start moving. We'd add to it. We'd scale into it. We must have scaled into this stock 3, 4, 5 times over the last 2 months. It's been one of the biggest winners financially for Carnivore Trading's model portfolio in 2023. So here's the math that comes with scaling, okay? As you can see, we buy the stock here and we add to it here, 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 and here. That's the scaling methodology. It's really important that you understand that this is the power behind achieving big returns. Most people will put $10,000 into 10 stocks and then they'll just let it ride. They won't scale into winners. They don't sell losers. This is a problem. This is why their returns are average at best. This is how you get a 4 or 7% return overall in a year's time frame. By scaling, that's how you can get 10, 15, 20, 25% returns a month. All right, one final thing. When you're scaling, if the stock pauses in its upward motion, you pause adding capital to it. Just makes sense. You're not going to add more capital until it earns more capital. When the stock gets tired, looks like it's going to be coming back and peeling back, that's when you pull the ripcord and you go ahead and bank the profits.